and welcome traders. I am Rachel Deschelle, Senior Manager of Trading Services and your host for this long options webcast. Now, in this webcast, we make the assumption that you are already familiar with the basic concepts of options. And if you are not, you are welcome to stay around, but you may want to check out the Getting Started with Options playlist first. Now, I am joined in the chat today by my good friend and colleague, Kevin Horner. He is going to be able to get to some of the questions, comments, requests that you have there in the chat, helping me keep an eye on those throughout the session today. Please give us both a follow on X. He is Kevin Horner CS. I am Rachel Dash CS. And please like this video and subscribe to us on Trader Talk Schwab Coaching. Now, I'm happy to be back with you guys. It's been a couple weeks maybe now. The wedding in May was the wedding in Maine, I should say, was a very fun time, but I'm happy to be back with you guys today. We are going to go through some back testing for long options today using our ThinkBack tool, and then I have a couple trades for you ready to go. So let's cover some of those important disclosures first before we get started. So options carry a high level of risk and are not suitable for all investors. The information that we're going to cover is for general informational and educational purposes only and should not be considered any type of recommendation or advice. And we are going to go through the Paper Money software application. Keep in mind that there are some major differences between Paper Money, which is simulated trading, and live trading here. Now, when it comes to our agenda, we're going to start this class the same way that we always do. So we're going to start with our market overview. We are going to discuss the concept of long options, get into our teaching moments there, and discuss the concepts of price, time, and volatility, all of those factors that impact the price of an option. And then we're going to play some example trades in the Paper Money platform. So let's dive in here into Thinkorswim and let's just take a look at what is going on in the markets because it's been a busy couple days. We've had a little bit of a pullback here, especially in the S&P 500. And I'm going to zoom in a little bit closer so we can kind of see what we're seeing right now with the price action. It looks like right now price is firming up and still holding above this level of horizontal support, really around kind of early May, this breakout here right around 72.90 or so. And that's actually where the 20 period simple moving average is coming into play. It looks like price is firming up a little bit above that even. Still within 2% of those all-time highs. And it looks like it's forming this possible, we call it like a northern doji, where the open and the close are roughly the same and they occur at the top of the candle there. That can be a bullish reversal type candlestick if we do see that follow through with tomorrow's price action. Or it could be a little bit of a hammer type candle that could be a bullish reversal type candlestick as well, with this little body occurring at the top of the wick. Now, something else here notable, I know kind of one of the things that I look at as a trader, I know other traders do as well, is we look at market breadth. So not just the trend in the overall market, but what the market of stocks is actually doing when it comes to participation. So are these stocks above their 200-day moving average, above their 50-day moving average? What are the advancing and declining lines looking like? And I thought this was a fun one to bring today. I brought this to this class before. You can see down below the S&P 500 chart, we have a McClellan oscillator. And so what this essentially takes is it's going to take a difference of a 19 period or a 19-day exponential moving average minus a 39 period exponential moving average of net advancers on the New York Stock Exchange. And it's going to give us this little zero line, which is going to act as a signal line. And then it's going to give us overbought and oversold signals. So overbought would be right around that 100 line there in red. Oversold would be right around that negative 100 line down here in red. And I want you guys to notice something. Every single time that the S&P 500 over the last year has made its way down to these washout levels in breadth, has become oversold, and moves back above that oversold line, that negative 100 line, it's marked these bottoms in the S&P. You can see that right here with this one. You can see that right here at the 20-day. Again, back in last October, you saw it again in November, and then you saw it again at the end of March when we had that major thrust off of the lows. We had that exhaustion gap there that closed, and price kind of ran away to the upside. So just kind of notice it is interesting that we're only about 2% off of those all-time highs, and we are kind of reaching some of these oversold levels in breadth because we have had a pretty narrow market as far as leadership. We've had a handful of names really kind of carrying us up to the upside. So kind of keep an eye on some of those levels down here when it comes to breadth. I have a couple other market update charts to share with you guys as well. We have obviously seen some big moves in rates, especially over the last couple weeks, but even more so this week so far, just even in the last couple trading days that we saw. We had this breakaway gap above this prior resistance. We made our way today past those yearly highs, so that's kind of what we're seeing now. And if we back this out a little bit farther, you can actually see that we have a long line of resistance right around 5% with the 10-year yields. And price has been in this coil on the monthly chart, which it's looking like it's starting to break out. Again, these are monthly candles, so we won't necessarily glean the most information from them until the month of May is complete. But you're starting to see intra-month that monthly candle is breaking out above this nearly 3-year long coil where we've seen that rates have just been compressed, volatility has been compressed, and it looks like it is breaking out to the upside with a bullish MACD crossover really taking place at the same time too. So that could be possible headwind for the markets, but again, something to monitor there. Another one here is the Russell 2000. So we lost the 20-day in the Russell 2000, but what I want you guys to notice here when we look at just kind of the structural support in the Russell, we are still holding that prior support from early January. So from that initial breakout, we have really held upon that level of old resistance, now new support, right around 2720 or so. And price right now is giving us that long wick again, showing that there is some buying pressure happening here in small caps with a little bit of a hammer candle. So again, one of those possible reversal candlesticks that is happening at a crucial level of support. So maybe we see a little bit of a reversal, maybe a little bit more rotation back into small caps, maybe rates cools off here a little bit. But obviously, lots of things that are up in the air, especially with geopolitics and things like that, that are putting a little bit of pressure on rates as well. So let's take a look and kind of get into the meat of our discussion today. So I talked about how in the beginning that we're going to focus a little bit on more of the back testing. So maybe just kind of analyzing what our trades would look like if we chose a different strike price or if we traded around an earnings event where volatility was a little bit higher. Or maybe just given different types of expirations, varying expirations, what our trades may look like there. So we're going to use the Think Back tool today, and we're going to use NVIDIA as an example. So we're going to take a look at the chart with NVIDIA first because this is probably on a lot of folks' radar when it comes to just Nvidia's earnings that are happening tomorrow after the market closes. Typically, we know that when we are trading options, typically long option buyers may want to avoid buying an option going into earnings just because of the elevated levels of implied volatility. So that's one of those factors that we talk about quite a bit in this class is when volatility is at lower levels, it's typically more of a regime that favors option buying. And the reason why is because if volatility is lower, you're going to typically have lower premiums as well. As volatility tends to creep up to the upside, you're typically going to have higher option premiums, which when you are buying options, you want to buy low and sell high and not vice versa. So that's why typically for option buyers, we look for a lower volatility environment. So we're just gonna kind of show a few different examples just using NVIDIA for varying expirations, varying strike prices, and really back testing these trades to see how these trades would have worked out in this case. So let's take a look first at just let's take a look first at the previous earnings announcement. So I'm going to actually add our implied volatility study down below so you guys can see the detail of exactly what I'm talking about of just kind of heightened volatility leading up into earnings and then kind of volatility getting baked out of the market in that stock quite thereafter. And so you can see with each of these earnings announcements, you can see the markers on the chart there of when these occurred. But with the recent ones, you had last August, you had a lead up into earnings, you had the volatility crush after, you had some of the highest levels of all the entire past year back in November when NVIDIA was really just chopping through the meat of this sideways pattern. And then you saw that with our last earnings announcement in February as well, when they still kind of dealt with quite a bit of chop in that case. So, and you're kind of seeing that now as well with these really heightened levels of implied volatility. If you look over to the left-hand side, you're seeing an implied volatility percentile of about 66. So it's telling you that NVIDIA is in the upper third, technically, of where its implied volatility has been in the last year. So this may not be the best type of environment for buying options. And we're going to show you exactly why, even though you could be essentially right in the direction of the underlying stock after earnings, where you may still have a little bit of hindrance on your premium because of the drag on implied volatility. So we're going to go through that. So I'm going to use this February the 25th as an example. And so what we're going to do is we're going to run through a simulated trade of buying a put prior to earnings and then seeing how that put value decays kind of after earnings or if it gains value because of the direction in the stock. And you can kind of see right here what the stock did as far as that type of announcement, how it reacted. You could see that the stock had a little bit of a run up, or I'll scroll in a little bit so you guys can see. Had a little bit of a run up in the week and a half leading up into earnings, and then it had quite a bit of reaction where it dropped nearly 20 points or so. So we're going to take a directional trade in that sense to just say, hey, what would our premium, what would our trade have looked like if we did buy that option before earnings to maybe hedge our long stock portfolio, maybe hedge a downward move in NVIDIA if we were right on the direction. We're just going to see how some of the impacts and implied volatility can affect us. So we're going to go back before. So let's go to the Analyze tab here, and we're going to go to Think Back. Okay. So if you guys have not used this tool before, essentially what you're going to do is you're going to take this date in the upper right hand corner, and this is going to be the date that you would have placed the trade. So this is your trading day essentially. So what we're going to do is we're going to take this all the way back to February. And we know that the earnings announcement was on February 25th in this case. So we're just going to say we're going to place a trade a week prior to earnings on the 18th. Okay, so we're going to go back to the 18th, a week before earnings, still when implied volatility is heating up a little bit. And we're going to look roughly 60 days out from expiration because we've talked about how really at the 30 to 40 day mark is when you kind of have time decay with your options, tend to kind of kick into high gear. So if you are looking for a possible trend trade, maybe to hold an option for a couple weeks, looking an additional month out may be a good practice for many traders. So we're going to look at the 17th of April with 58 days until expiration. And the price of the stock on that day was 184.97. Okay, so 184.97. And we know in this class quite a bit, we do look for maybe a delta of around 60 that tells us that, hey, this option does have intrinsic value. It is in the money. We are going to see roughly, theoretically, a 60-cent move on our option per dollar move in the stock. We'd have a roughly 60% chance of our option expiring in the money. So we're just going to use that guideline when it comes to our deltas. Well, I guess we're going to do that from the put side, I should say. So we're going to look at a slightly in the money put here, and we're going to look at the 195 strike put here. Okay. So we're going to go with this one, the 195 strike put. And so all I had to do was I clicked on the asking price just as I would build a trade with this one. And essentially what we're going to do is it's going to add the trade down here. And so this is essentially going to show us our trade date. So this would have been the closing prices of all the options on the day that we would have placed the trade. And so right here, it's just looking at the midpoint or the mark between the bid and the ask on that close. So this is going to give you, again, stagnant closing prices of what the prices of the options and the stock were on that day. So now what we can do is we can say, okay, let's say we held this option through earnings. Let's say we maybe held it a couple days after earnings. So maybe 3 days after earnings. So we know that the earnings announcement was on the 25th. Let's just say we wanted to see what the price of our option was by the 27th. So let's just go 2 days. So we can actually see if we would have held that option. So if we would have bought that option a week before earnings to hedge ourselves a little bit, we would have bought a put. We still would have been at a loss on this option of roughly $172 due to the movement of the stock, due to the implied volatility decay, due to time decay, factors like that. So let's go back to the chart and just see the days that we would have purchased it. So our trade date was the 18th, and we're kind of checking our profit and loss by the 27th. So that gives us a little over a week. So we would have placed this trade on the 18th, so on this day. And so we saw that price had a little bit of run up into earnings, but then it was lower than where we initially bought the put option. So I'm going to highlight this for us. This is the day that we would have purchased the put option leading into earnings, this red candle. And this is the day that we would have seen our profit and loss on that, where we would have essentially closed out of that option due to that reaction in the stock price. So you guys can kind of see a few different things kind of shaping up here. So one, we were right on the direction because we placed a put trade when the price of the stock was right around 188. And by that close, the price of the stock was $11 cheaper or $12 cheaper. So within just over a week of time, so a week and a half of time, this stock essentially from point A to point B lost $12. So you would essentially think that because of the direction, we would essentially be at a gain on this type of option. But we know that we have some of these other factors that are working against us. We know time is working against us. So we had a little bit of time decay. We didn't have a ton of time decay. I'll kind of pull back to this page here uh, with our Greeks here. We had a little bit of time decay, which was roughly about 10 cents a day. So if we held this for maybe 9 days or so, that's still roughly about 90 cents. We had our volatility or our Vega sensitivity because the implied volatility fell a few percentage points. You had a little bit of that crush in the Vega as well. And then something else that doesn't get talked about enough is also the fact of how your delta and your gamma can also respond to changes in the stock. Because remember, before that stock went down, it went up. So we saw this stock run up all the way to roughly 196, 197. So it did have a $10 move to the upside, placing our option actually a little bit out of the money. So it actually placed our option a little bit out of the money, which would have given it a little bit of a smaller delta. So we would have seen that our delta would have gotten smaller and smaller. And so then when the price of the stock moved back in our direction, we had a smaller delta in that case, saying that we had that move to the downside that wasn't working as much in our favor as it would have if we would have purchased the option a couple days later or not traded around earnings to see that volatility crush and things like that as well. So I wanted to show you guys that because sometimes you can be right on the direction, but because some of these other factors kind of line up, whether it's you had a kind of like the gamma or the gas pedal influencing the rate of change in your delta with what you'll typically see with higher with at the money options. You'll typically see those with weekly options a lot more where that those at the money options can be a little bit more volatile, a little bit more sensitive to the price of the stock. But you saw that volatility decay as well as that volatility just baked itself right out of the option after you had that earnings announcement. So that's just kind of one of those examples on, hey, you can be right sometimes, but if the environment, if some of the other factors that impact your option price don't align, it could be a hindrance to profitability within your strategy. So that's why we talk about why all of these different factors with option pricing are so crucial and so important, and a trader needs to consider all of these different factors about an options price before building a ton of conviction in taking a directional trade in this case. So that's just one example there. Now let's go through another example of maybe just going through when we did have a little bit of a breakout in NVIDIA with a break of resistance. So let's kind of look at the last few months of price action here, and I'm going to draw this little range that we saw here. Okay, so we have this range that took place for really multiple months at a time. We had that little failed breakdown there. Really looked super similar to what we saw in the overall market as well, where we had that little exhaustion gap that got filled and then the market just kind of ripped to the upside. So let's just say we would have bought an option right here at the breakout. So we're going to talk about buying breakouts and getting directional with buying breakouts. And we can see here at the same time, we can also see that the implied volatility during that time period was relatively low as well. So you can see over the past year it was in a relatively low area of implied volatility. So a bullish breakout with a break of resistance and a lower volatility regime, no upcoming earnings in the next couple weeks, kind of builds the recipe for a little bit higher conviction going into a long options trade or a directional options trade in this case. So let's just make our trade date. I'm going to write this down so I don't forget it. So our trade date is going to be on the 14th. And let's just say we sold at this level of resistance here. So let's just say we're going to sell on the day on the 27th, 427. So right when we saw that high. Okay. So let's take a look back at the Analyze tab. Let's go back into Think Back, and we're going to look at this from a couple different angles. So we're going to look at this with varying expirations, and then we're going to look at this with varying strike prices to give you guys a little bit of an idea. So of how the price of the stock and some of these factors will affect different levels or different varying strategies, I should say. So I'm going to change this back to the date of the 14th because that's the day that we had that breakout of, or wait, that was 414, not 214. So we're going to go to 414 here. And that was the day that we had the breakout. And so what we're going to do is we're going to look at a couple different expiration dates. So we're going to talk about the expiration dates that we just kind of used with looking about 60 days out from expiration. And then we're going to also look about 30 days out from expiration. So we're going to look a month out and we're going to look 2 months out. And keep in mind, we're going to be holding this trade for about 2 weeks. Okay. So we're going to see about 2 weeks in time decay. So let's go with the 15th of May. So we're going to go with this one with 31 days left until expiration. We know that that's when that time decay tends to kind of kick into high gear is at that 30-day mark. So we want to keep that in mind. Now, let's follow our same rules about buying a slightly in the money call option with a delta of roughly 60. We're going to look at the 185 strike call in this case, and I just added that to the bottom there. Okay. And you guys can see right now the time decay on this one is a little bit more, it's a little bit higher for at the money options as well. So this one's just kind of slightly in the money. You'll see that the at the money options will have that higher sensitivity to time decay. So if you want to maybe avoid that a little bit more, you could go further in the money or further out of the money. Just keep in mind you're going to have your trade-offs with other factors like price, delta, vega as well. You'll also see the highest sensitivity to volatility with the at the money or slightly out of the money options as well. So keep that in mind. So let's compare that to an option that is about 2 months out from expiration. And we're going to go with the same exact strike price. So we're going to go with the 185 strike price. It has a delta of roughly the same. So they have a delta both of roughly 60 or so. And we're going to look at how the prices of these options will differ. Now, you notice there is quite a difference. You're paying about 50% more on the same strike, but a month later on expiration, because that's the extra time value component that you're carrying there. So if I open this back up, you'll notice that you have a little bit less of time decay, about 3 cents less in time decay. But keep in mind that the closer and closer we get to expiration, you know that time decay is going to get even bigger and bigger. So notice the prices there. You're paying a little bit of a premium for an extra month in time, but the benefit is again that you do have less time decay on that option. So let's say we go forward to when we did see that little bit of a peak, short-term peak in NVIDIA on the 27th. So let's just say we held this for roughly 2 weeks. We're going to see what our profitability would look like on the options. Whoops, and I switched that to the wrong one. this is where you switch the profit and loss date. So on the 27th here, this is what we're going to go with. And notice here on the options here. So notice our profitability. So you'll actually see here our delta gets greater and greater on the option that is closer to expiration. So it's going to have that higher sensitivity to the movement in the stock. And since the movement in the stock did move in our direction, you notice that delta is getting larger and larger, and our option price is going to respond a lot more. So even though there was more time decay in that option, possibly, you are still seeing a greater profitability on that option because of the delta on that option that carried that price of the option forward in that case. So you're seeing you paid a premium on the one that was about 2 months out from expiration, and notice your profitability is about $200 less or so. So that's kind of another way that you guys can look at this is maybe testing different expirations, seeing how they respond for the same strike prices. You can change this with different strike prices as well. But if we just then kind of look at both of these, so I changed this one to the day that we would close out the option. So this one has about 18 days left until expiration. I'm going to show you guys where our option is now. It's so far in the money here to where its delta has become so large. So for every dollar move in the stock, our option's going to move about 93 cents. And the benefit of that option moving so far in the money is you actually don't have the same sensitivity to time decay as you would have with some of the at the money or slightly in the money options. So we thought we were going to get hit really bad on time decay because it was kind of near the areas of that time decay curve. But because the option moved so much in our favor, we actually didn't really have to worry about time decay much at all in this case because of how much this option did move in the money, how much intrinsic value that it really brought, that it's now trading on more almost purely intrinsic value versus extrinsic value, which is that time component there. And if we actually look at the other one that we had placed, we can actually see that the 185 has a little bit of a smaller delta in this case. So you can see the delta sensitivity is another thing that you want to actually keep in mind as an option buyer as well, because the sensitivity to your delta is going to get greater and greater the closer that you get to expiration as well. So, let me know if you guys have any questions there on that one there. Because we're going to run through this one more time. I promise we do this with different strike prices as well. So we're going to use that same really short dated expiration with 30 days out, I guess moderately short, I should say, with 30 days out until expiration. We're going to look at the 15th of May here. And we're going to look at a couple different strike prices. Okay, so we're going to look at a in the money option. We're going to look at an at the money option, and we're going to look at an out of the money option. And so hopefully what this is doing is it's giving you different ideas on how you could craft your option strategy and how these different scenarios play out with these different strategies, because there's no one right way or wrong way to do things when it comes to options. Each strategy, each approach is going to have its pros and cons. It's going to have its benefits and its pitfalls. So it's all kind of a weighting mechanism to see kind of what you weigh more with higher conviction with that particular trade, and what the back test looks like for that type of strategy as well, if it is a profitable strategy over time. So this is just kind of one way you can do it. So let's look at an option that has a delta of roughly 70. So let's say we're going to look at an option that is not too deep in the money, but is decently in the money. So it has about a 70% chance that it's going to expire in the money in this case. So we're going to look at the 180 strike with about $10 roughly in intrinsic value. We're going to add that as a call option here to say, hey, we're going to pay a little bit more, but if we are right in the direction, we're going to have a little bit more movement in our option. So that's kind of the offset there. We're paying a little bit more for more intrinsic value, but if it does move in our favor, we're going to see bigger moves on our option there. So that's kind of what we're doing with this one. Now let's buy an at the money option as well. Let's look at the 190 strike call. So the price is around 189. That's the closest to being at the money. So we're going to add that one as well. And then let's look at a slightly out of the money option one. Let's look at 10 points out of the money. Since we looked at 10 points in the money, we looked at the money, let's look 10 points out of the money. So 10 points out of the money would be about the 200 strike. Look how small the delta is on this one. So about a 30% chance that that option would expire in the money. It's also telling you that with a $1 move, that option is going to move roughly 31 cents. But the benefit on that one is that you're paying a fraction of the price that you were paying in the other options. You're paying less than half the value that you would for an at the money option, and you're paying about a fourth of the value that you would be paying for that in the money option. So let's fast forward to that day about 2 weeks in advance, the same day we used before, and let's see how those option prices respond. Okay. So we just did that. You can see down here in the bottom right-hand corner, you're going to have the greatest profitability, obviously, on the in the money option. And the reason why is because your delta gets so large and your theta gets smaller. Okay, so your delta is going to get larger and larger, which you can see it moved to a 95 delta. So you have an option that's almost trading purely on intrinsic value. And then remember with the last example, when your option moves so far in the money, your theta is going to get smaller and smaller. So you're not going to have as much sensitivity to that time decay because you have less extrinsic value and you have more intrinsic value in your option. So that one is going to have the largest amount of gains. Now, it's a trade-off, right? Because you spent so much more on this option and you're seeing about a couple $100 more worth of gains. Now, if you look at the at the money option, you paid about roughly half the price as the in the money option, but you're only about $300 behind in profitability. Your time decay is a little bit more, but still it's not really lagging too much. And then lastly, you're going to have the most time decay, the most sensitivity with that money, that out of the money option, or the option that started out of the money, the 200 strike option, because of just kind of where we kind of started. And now looking back, you can see we're still at a dollar value gain, but we're actually at a larger percentage gain likely on that option. So if we kind of look here at the 27th and we take a look at these strike prices here, we can actually see that we're going to have the largest dollar value gain when we buy an in the money option, but we're likely going to have the largest percentage gain when we buy an out of the money option. So if we take a look at that 200 strike call, it's now worth 19.35. So that went from $3.32 to 19.35. So that is multiple times, a couple hundred percentage gain on that option that you're seeing there. Whereas these other ones, you're still going to see a large percentage gain, but it's not going to be as much of a higher percentage gain as the out of the money option just because it started at such a smaller price, if that makes sense. So, any questions there on those examples, you guys? Any questions on those examples? Yeah, Kelly, this is a underrated tool on Thinkorswim that you can use for your options pricing. So I wanted to finish it out by placing an options trade within the last couple minutes of this class that we have, taking all these factors into consideration that we talked about. So this is a stock, United Healthcare. It is sitting at some of the lowest levels of implied volatility in the last year, really down here at 31%, close to 32%. It has an implied volatility percentile of 7, so very, very low. We did have this retest of support right here with United Healthcare as well. And with that retest of support today, we're having this possible bullish engulfing candlestick. So that is giving us that little bit of confirmation or a close above the high of the low day, even possibly from this support retest of that horizontal support. So as a directional options trader, this could give us a favorable scenario to build a little conviction to say, hey, volatility is a little bit low. We had a little bit of a pullback, a little bit of a retest. Now we may be seeing the start of that confirmation for a continued move higher because we haven't necessarily seen a break in the trend. So if we're going to kind of go through some of the steps that we went through before, let's just say we're going to look at a very short-term trade. So let's take a look at the 18th of June with 30 days left until expiration. And let's just play a really short-term trade in this case, using some of the things that we talked about. So let's look at a delta of roughly 60. Let's look at an option that is slightly in the money. So we're going to look at this option that is roughly, let's say, about 10 points in the money. So we're going to look at, yeah, let's go to the 382.50s. Let's go to this one. Okay, so we're going to go right click, buy custom, and we're going to go with stop. Okay. And so what we're going to do is we're going to add about 4 contracts here. We're going to add 4 contracts. We're going to link those together, and we're going to put a stop on that's going to trigger off of the asking price if it drops below, let's say, 14. Okay, and so we know that the most that we are risking in this trade is what we are essentially paying for this option. So I'm going to show you we're paying the premium of this option. We're still staying within the risk parameters of our account. We're spending roughly about $7,500 of how much we're risking, because that's the most we can lose, and the most we can make is to infinity. So we have no cap there. We're going to move up our stop as we go. But essentially what we're going to do is we want to give ourselves a little bit of breathing room to the downside. We're still going to stay within that 1% risk of our account. This is going to trigger off of the asking price. So when the asking price of the option hits 14, this becomes a market order. Keep in mind that there may be a risk with stop orders, especially if the stock gaps down overnight. The price of the option may not open anywhere near the stop or the activation. So keep in mind that is a risk with stop orders. We do have a pretty tight spread on the bid and the ask, a pretty liquid market in United Healthcare. If you wanted to look at the volume and open interest of some of the other contracts as well, weigh your pros and cons of doing that. But essentially, we're still staying within those risk parameters of our account. And then as the price of the stock moves in our direction, we are going to move up the stop with it. But essentially what we're looking to do is hold this trade for a very short amount of time. We saw on the examples that we did, even if we're holding this for a week and a half, 2 weeks, and this price of the stock does move in our direction, that will counteract some of the time decay that we may see on that option as our option does move in the money. So we're going to hit confirm and send here and send this to our long options class, and we're going to hit send. Okay. So that order is in and working. So we got one trade in today. I know we took a very, very deep dive on the think back tool, but hopefully that helps you guys just again test out some of those strategies, even go back with the strategy that you tend to place within your account possibly, or that you're doing within your paper money account. Back test it on that think back tool. I think think back is again another tool that may only be in live, so keep that in mind. And think back only shows those closing prices, but again, really great back testing tool to make sure that the environment is favorable for being directional with long options. Well, if you guys liked the session today, please give it a thumbs up to help other traders find this content as well. Thank you so much to Kevin in the chat. You guys were great today. Good questions. I'm glad to be back with each of you. And then please give Kevin and I both a follow on X. He is Kevin Horner CS. I'm Rachel Dash CS, and please subscribe to us on Trader Talk Schwab Coaching. Thank you, and see you later, traders.